Good afternoon, Futex traders and Futex Live subscribers. Welcome to my FOMC fundamental trader preparation. Today I'll basically be going through what I normally go through, essentially how the things we should look out for in preparation for the FOMC meeting, go through some of the statement science, etc., etc., and then tomorrow in Reg's debrief he'll go through his trade plans. But for this component, it's literally our fundamental preparation and what we need to be aware of. So, excuse that. Objectives. What we're going to go through today is, first I'll talk about the meeting format. To those of you seasoned Fed traders, this won't be anything new to you. Fed mandate the same. We'll then go through what happened at the previous meeting, touch upon the statement, the minutes, and the market reactions. Then quickly go through the data since the previous meeting, and then more of the what I call fun stuff, market pricing and expectations, and the key focus points, i.e. the real two areas that we can potentially make money from trading the Fed if we've prepared well enough. But essentially points 1 and 4 on here are a little bit more dull and a bit more boring, but they're required to make money out of sections 5 and 6. So let's move on. Okay, so the format. Meeting is actually started today and goes on for 2 days, but all the announcements happen tomorrow. So Wednesday the 16th of March. For those of us in London, please do not get caught out. It is at 6 p.m. Due to the 4-hour difference in the clocks. The US changed their clocks just this last weekend. The UK is still to do so. So first thing not to get caught out on is that London time at 6 o'clock, 2 p.m. Eastern time. Normally it's London time 7 o'clock. So don't be out to dinner or anything like that and come back at 6:45 because you would have missed the show. So anyway, at 6 o'clock we get an announcement of any change in the Fed funds rate. We also get any announcement of any QE or tapering, which we haven't had for a while. We get a statement released. We get the updated summary of economic projections, and we get the updated dot plot. Now, this isn't the format at every meeting. Every other meeting we get this. Some meetings we just get an announcement and then a statement release. This meeting we get the projections, the dot plot, and then at 6:30 this meeting as well we get a Yellen press conference and a Q&A. Now I've put a little bit here about the implementation note. This is really only if they hike rates. When they did hike rates in December, this is what we got. And this details the specific measures the FOMC will use to implement policy changes. As we'll find out later, there's not really much expected in terms of a rate hike, so we probably won't get this time around, but we never know and we need to be prepared. Okay, so the Fed mandate, again, it shouldn't be a surprise. It never really changes. It's to support continued progress towards maximum employment and price stability. Essentially, there are two policy targets, employment and inflation, i.e. price stability. So what happened in the January meeting? Rates were left unchanged. This was a unanimous decision. The Fed signaled concerns on the economic outlook. They showed renewed worry about financial market turbulence and slow overseas growth, particularly China. They were monitoring global economic and financial development for its balance of risk view. So what they actually did was they removed the reference that risks to the outlook are balanced. In previous statements for a long time they'd done that, and they removed this balance term, which essentially the market viewed as a little bit dovish because they no longer thought the risks were balanced. They also repeated that the economy expected to run only gradual rate rises. This was nothing new, but a reiteration, slow and steady interest rate rises. But the key thing, they still said interest rate rises despite some of the global turbulence that we've been having. They still saw the effect of energy decline and strong dollar as transitory, hence allowing inflation to rise in the medium term. What was quite significant, and another pretty dovish slant, the Fed dropped the reasonably confident line that they often put in the statement. So they dropped reasonably confident on inflation heading back towards its 2% target in the medium term. They still mentioned this, but they didn't have the reasonably confident element in it anywhere in the statement. And finally, they did not rule out a March hike. And we've come to March now, so the meeting is very much live. So that was in the statement itself. Since then, we've had the minutes as well, this little area here, where we found out there was discussion about altering the appropriate path for the federal funds rate, which actually could set us up for a reduction in the dot plot at the March meeting. They also talked about most seeing solid jobs market this year, with several seeing moderation. That wasn't mentioned in the statement, but purely in the minutes. A number of officials concerned about the drag on the US by China. Not really surprising. They talked about slow overseas growth and market turbulence, and that was obviously China-led, but in these minutes they actually explicitly mentioned China. And again, no surprise, a number of officials saw inflation outlook more uncertain, hence probably the reason why they dropped the reasonably confident line within the statement. So that was January. Market reaction on January. So first of all, I'll just touch upon the STIRS bonds, equities, and FX. So on the STIRS, there was essentially a sharp rally on the announcement of about 6 to 9 basis points across the strip. If I bring up a chart here, this here is back on the 27th of January. This is a 5-minute chart of the Eurodollar. DEX 16 contract Eurodollar STIRS, not the FX. So we'd actually come off over the day down to close to the day's lows pre-meetings, a bit of pricing, and maybe participants thought the statement wasn't going to be overly dovish as what could have been, but ultimately came out probably as dovish as could have been, and the whole sell-off over the day had reversed in the space of 5 minutes. And that was quite an aggressive move, upward move in the STIRS. So, from 99.05 up to 99.12, 7 basis points. This is in the DEX 16s. If you go probably a bit further out the curve, it's more like 9 basis points, i.e. 18 ticks. But pretty aggressive, and the market was very clear on which way it should go, and that's ultimately what happened. Then, just move that for a second. The bonds, similar to the STIRS, the Treasury recovered off the lows and bounced higher, with the belly of the curve outperforming, with the 5-year in particular leading the market higher, and hence we saw a steepening of the curve. 530s in particular steepened 4 basis points over the announcement, which was quite a big deal. I've got a chart of that here as well. So this is a 5-minute chart. 5-year yields dropping from best part of 148.5 in the first 5 to 10 minutes, down to 143, and then extended down to about 141. So about, again, 7 to 8 basis point drop in yields in the 5-year yields. And this is the curve, 530s, quite a significant steepening from 134 up to 138, which, as we've seen over the day, it was very, very stable. A little bit of flattening pre-FOMC, and then quite an aggressive steepening afterwards. And these are the sort of patterns we should look for as bond traders. When we want to buy products, we want to know what's the most sensitive, what's the best one to buy if the Fed are dovish, if the Fed are hawkish, what's the best one to sell, because invariably what may be the best to buy will not necessarily be the best to sell. So always kind of have these correlations in mind, what the curve is doing, what outperforms, what underperforms, etc., etc. I'm not going to go through that now, but that should be part of your own preparation for FOMC, especially if you're trading the US bonds. Okay, then in equities, wasn't overly interesting. It was pretty choppy initially, and then the US equities ground lower as the session went on. I'm not going to bring a chart of that just yet. I'll bring an equity chart up a little bit later on. And in FX, we got a knee-jerk move lower in the dollar, but even within that, it was pretty choppy, as when I bring up the chart, the candles will show. Obviously, on a dovish Fed, we'd expect the dollar to weaken, but it wasn't as easy as it might have seemed. After the first 6 or 7 minutes, the market remained fairly stable and balanced. So again, this is a 1 minute chart. Here we have the dollar index, the dollar index, and here we have the euro dollar. So whichever one you want to look at, I'll look at the dollar index. Depreciation of the dollar, but within that you can see the candles are quite big, not just the first candle, but candles thereafter. This actually was the first candle here, it didn't move very much. Second 1 minute candle, quite a bit of chop, quite a big range. It wasn't completely easy. Then the dollar did come off, bounced a little bit, then just balanced. If we look at the euro, same thing. Obviously it's euro dollar, hence why it's an upward slope here, and then after the initial 6, 7, 8 minutes, it balanced. Looks fairly easy, this bit here, but it was a bit choppy within these 1 minute candles, so they weren't the easiest things to trade. Okay, so that's basically what happened last time round, and often history does repeat itself and we see the same patterns, and that's why I've gone through the market reactions for what happened last time. Okay, so the data over the past month. So we've had 2 non-farm payrolls numbers since the last meeting, given that was the end of January. In March we had pretty strong NFP number that came in at 242 versus 195k expected, and we also had some upward revisions. But what significantly, the average hourly earnings were a minus 0.1% drop versus 0.2% expected. That would have been worrying if in the previous month we didn't see this. So in the previous month we actually saw a 0.5% average earning versus 0.2% expected, and the talk is that it's basically a bit of an anomaly, a bit of a calculation issue, whereby this was lower than it should have been and this was higher than it should have been, and then generally the market took it as actually over the 2 months not much has changed. And similarly here, a much lower reading than expected on the actual NFP, but a much higher reading in March. So they're kind of inversely correlated, and net the markets looked at the 2 months together, which is what I'm doing now, and it's still a pretty solid jobs number. Other data, PMI manufacturing generally been strong, represented by the greens. Essentially greens are the better than expected numbers since over the last month, and you can see over here PMI manufacturing, core PCE, core retail sales, preliminary GDP, they're all much higher than expected, and so the data's been pretty solid. Looking at inflation numbers, core CPI, we have CPI out tomorrow. The last reading has been 2.2% year on year, and that's what's expected tomorrow. And that's actually been the highest level in the last 4 years. So encouraging on the inflation front. We've talked about the Fed looking at inflation, employment. Employment's been okay for a while. Inflation is what they've had their doubts about, but this is encouraging. It's the highest level in 4 years. Similarly with core PCE, which is the Fed's preferred measure of inflation. The last reading came in at 1.7% year on year versus 1.5%. This is also the highest that it's been in a couple of years, and edging towards that 2% level that the Fed often talk about. Also things we need to pay attention to: China and the oil and dollar performance, but I'll touch upon that a little bit later. But overall the data over the past month has been positive. So if the Fed essentially, and if Yellen is positive about these things, we shouldn't be too surprised because we can see the data ourselves. Okay, so moving on in terms to pricing and stuff like that, I often look at the dot plot. This here is just a comparison between September versus December. December was the last time we had the dot plots updated. So it's just something nice and visual that you can have a look at to see how things have changed. So essentially this time around we're looking at December to March. And how that changes. Okay, so market pricing. So the current Fed funds target rate is 25 to 50 basis points. The current rate is within that, near enough in the middle. It's 36 basis points. Now, according to the Fed funds futures, the market is pricing an 8% chance of a 25 basis point rate hike for this current March meeting. So there's a small chance. It's about 1 in 11, 1 in 12 chance of them hiking rates. So by looking at that, if they do hike rates, it will be a surprise, and that will provide opportunity. So it's always important to know what interest rate markets are pricing, what the likelihood of a rate hike is. If they don't hike rates, it shouldn't come as too much of a shock, just because there's only an 8% chance priced. The next hike, the full 25 basis points, is priced for October 2016. So still some time away. So we get the Fed dots released at 6 p.m. tomorrow, 2 p.m. Eastern Time, and the current Fed dots are 1.375% for DEC 16, 2.375% for DEC 17, and 3.25% for DEC 18. You can see the market is priced very differently, very differently. You know, there's good 75 basis points there, 125 basis points there, 100 basis points differential. So, as has been the case for the last couple of years, the Fed dots are a lot higher than market pricing. There's been this disconnect. The opportunities come essentially if the market pricing meets the Fed dots, more if it moves towards it, as opposed to if the Fed dots come towards the market pricing. But what this shows is essentially that the Fed meets 8 times per year. This is the second. Today and tomorrow rather will be the second meeting of the year. The Fed essentially, if the dots aren't changed, essentially means the Fed need to hike 4 times this year. So 4 out of 7. Chances are they won't hike tomorrow, so 4 out of 6 if this remains the same. Similar 4 times in 2017, but the market is going 1 to 2. 3 to 4 times in 2018 to get from this right here to this right here. Market's thinking just over 1. So essentially, market expects a slower pace of rate hikes going forward than the Fed. Now, obviously, these Fed dots might be downgraded a little bit. Tomorrow, we'll only find that tomorrow. But if they don't, that is super hawkish, because it essentially means this year 4 times is still what the Fed believe is required. Remember, the dots though are a median forecast, so it's not 100% wholly accurate. And I have actually read recently that a few of the bigger players in the market, some of the hedge funds, the PIMCOs, the BlackRocks, have actually played down the dots a little bit and their significance, because the Fed have seemed to just have, I guess, too optimistic a view, and then when it comes to the crunch, they don't really deliver anything. But that's just a few things I've read. But it's always important to know this, because the market do move on any changes in the dots. So key focus points in terms of where we can make some money. We now know about the market pricing. We know how the market is priced. So next is essentially the things I think that are most important for us to look at and be aware of in terms of how we trade the FOMC tomorrow and how we can make money out of it. So first and foremost, Fed funds rate announcement. 2, being aware of the updated dots. 3, the economic outlook, both what it is, what the Fed has said they expect, and what actually comes out tomorrow. 4, the language and forward guidance, and then 5, the global outlook. So the Fed funds rate. In blue on the top of these slides, I've generally mentioned where we should look out for these things. So as I mentioned at the start, we have rate announcement, we have dot plots, we have projections, we have Q&A, we have statements, we have press conferences. The Fed funds rate will come out at 6 o'clock, and it's only the rate announcement we need to pay attention to for this particular aspect. In the statement, this is where they kind of referred to things about the rate about the rates. It says, last time round they said, given the economic outlook, the committee decided to maintain the target range for the federal funds rate at 0.25%. In determining the size future adjustments to the target range for the Fed funds rate, the committee will assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation. Nothing new, we know this stuff. So what we need to really think about is 25 basis point rate hike. They only will really hike rates if they believe these above conditions have been met. Well, this one in particular. realized and expected economic conditions relative to its objectives of employment and inflation. As I said, the STIR is only priced an 8% chance of this. So if we do see a rate hike, it will be a surprise and potentially opportunity to make money. But how likely it is to come is essentially due to this statement here. Unchanged rate is the consensus view, and to add to that, using Fed funds data since 1994, we have never actually seen a rate hike being delivered unless the market pricing was at least 60% or higher. If we remember last year when the Fed hiked in December, they essentially prepped us in September and told us that the December meeting was live. And going into that meeting, we had about an 85% chance of a rate hike priced. This time it's very much the other way around, so the market is not expecting it. This is just, what I put here is just a bit of historical context. History is there to be changed, and just because something has held for the last 20 plus years doesn't mean it will still hold. But in general, the market price is 60% chance or higher, because generally the Fed does prepare the market and provide the forward guidance. So if the Fed doesn't hike rates, then the forward guidance they give is what we should focus on, and that's why I've got it as a key focus point, which I'll touch upon a little bit later. Updated dots. So the median dots, we showed what they are currently here. These are all expected to be slightly lowered. So the 2016 dots expected to be lowered 0.25%. 2017. Sorry, I've just had a bit of a typo, but down 0.25%, and 2018 similarly down 0.25%. So the 2016 dots being lower, that's one possibility that might happen, and this is the consensus view. If it is lower, then the focus then moves on to the statement and the press conference, because it's expected to be lower. If it's unchanged, this is extremely hawkish, especially, well, if they hike rates, it's, the trade is there to do straight away. If they don't hike rates and the dots are unchanged, this is still very, very hawkish, because that would mean they've left rates unchanged, and then there are only 6 meetings left this year to move the equivalent of 100 basis points. So generally they move in 25-point increments. So if the dots were unchanged, that means essentially 4 rate hikes in the next 6 meetings is what the Fed expect, and that's pretty quick. So this unchanged dots would be very much a hawkish surprise and an opportunity to sell the bonds, buy the dollar, sell the STIRs, etc., etc. But it's also important to know how the dots come about. They are a median projection, and sometimes the median projection can be unchanged, even though a number of officials may lower their forecast. And just bear that in mind. Even still, I think an unchanged dots is still hawkish, but just bear in mind, it doesn't mean that it could actually, the average still could be lower, even though the median is the same. So just bear that in mind. Finally, the 2017 and 18 dots come out as well. Obviously, it's maybe something to pay attention to, but to be honest, I don't think it's overly significant at this meeting. They're expected to be lowered slightly, but to my mind, as traders, our focus should really be 2016. The market at this stage is not too concerned about what's going to happen in a couple of years. They're concerned about the here and now, when the next rate hike is, and how quickly they will move this year. 17, 18 is just a guide for the economists to plug into their models. As traders, I don't think we need to worry about it too much. But where we do need to worry about the medium term, 2017, 2018, is in the economic outlook, because the Fed's inflation target is a medium-term inflation target. So stuff about the economic outlook could come up in the summary of economic projections, it could come up in the statement, it could come up in the press conference, it could come up in the Q&A. So there's lots of areas where the economic outlook can be touched upon. Last time in this statement, the Fed said inflation has continued to run below the committee's 2% longer run objective partly reflecting declines in energy prices and in prices of non-energy imports. Then said inflation is expected to remain low in the near term, in part because of further declines in energy prices, but to rise to 2% over the medium term as the transitory effects of declines in energy and import prices dissipate and the labour market strengthens further. So this is the Fed telling us essentially what they're looking at. It shouldn't be a surprise. Has this medium-term inflation outlook changed? 2018, well, they will, as part of their summary of economic projections, release forecasts for 2016, 17, 18. The 2018 forecast is currently 2%. Is this still the case? Is it higher? Is it lower? Will the Fed add reasonably confident back into their statement that they're reasonably confident that it will go back to 2%? There's plenty here. This low inflation has been due to reflecting declines in energy prices. I'll talk about oil a little bit later, but we've seen a little bit of a bounce in oil. They've talked about these transitory effects of declines in energy. Are they right that it's transitory? Because we've seen a bit of a bounce in oil, and so on and so forth. There are loads of things that, could be changed here to a more hawkish tone, a very hawkish tone. If it's kept the same, I think the market will take it as dovish, because looking at the data, looking at what's been going on in global markets, it does seem that things have improved. But if the statement doesn't change, it will be taken as dovish. So I think there's some expectation for this, for a more upbeat Fed, given where we've come from. So there's plenty there. I'm not going to go through every little thing, but as part of your prep, you should analyze these things in particular, because inflation is probably the one thing that's really preventing them, in terms of the data at least, from pulling the trigger. And we've seen the data that I touched upon earlier. CPI is the highest it's been in 4 years. Employment, it does seem to be something the Fed have been happy with, and in the statement where they generally touch upon it, last time they said the labour market conditions improved further even as economic growth slowed late last year. And they also said last time a range of recent labour market indicators, including strong job gains, point to some additional decline in underutilization of labour resources. Again, I don't think there's going to be too much opportunity on the employment side, and for me the focus should be more about the inflation. But in the Q&A, often there's opportunities, but SEP, statement, press conference, it could be anywhere, so that's something not to switch off to. Language and forward guidance. I think this is particularly important. If they don't hike rates, or even if they do, you probably get more extended moves because of it. But if they don't hike rates, I think this is particularly important. Because like I said, and probably more important than some of those dots apart from the 2016, because the market is focused on the next hike, when it will be, how soon, how aggressively the Fed will go this year. And we've seen the disconnect within the dots, and this is why the language and forward guidance will be important. So language and forward guidance could come up in the statement, press conference, or the Q&A. So there's different areas to pay attention to. So last time, their language is generally in determining the timing and size of future adjustments to the target range for the federal funds rate. The committee will assess realized and expected conditions relative to its objectives of maximum employment and 2% inflation. It's nothing new, we know this, but this is the thing they always bang on about, so we should pay attention. Committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal fund rate. Note the word gradual. Has that changed? Will it move to very gradual? Will it move to, some other thing? Balanced, measured, gradual normalization. FOMC members have emphasized rate increases to be slow and gradual. Is that still the case? I expect it to be the case, but obviously what we look for is outliers and differences, because that's where we can make money. If the Fed deliver what we expect, there's not that much opportunity. We're looking for these left field bits to the statement, and I don't think you'll find it here. But again, if we don't know what the terminology generally is, if we hear the term, or in anywhere that the Fed are going to move gradually, you might think that it's a big deal, but if they've been banging on about it before and you haven't prepared, you won't know that actually it's nothing. And they also say the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. So essentially, their continued emphasis is on data dependency, and that's irrespective of the rate decision they move. They've always talked about the data warranting rate hikes as opposed to the calendar. The market is obsessed with, is it March, is it April, is it June, is it October, is it December? The Fed aren't never commit to a date. Or very rarely do. What they're focused on is, it doesn't matter what month. They're looking, the rate hike will come when the data warrants it, not when the calendar warrants it. And finally, in the forward guidance, changes to any press conferences. Could we see any changes? Analysts have suggested in the past that the Fed might hold press conference after every meeting going forward. If they bring this up and mention this, it could be a signal for future hikes. They haven't hiked rates at non-press conference meet. Well, they haven't hiked rates generally, but a lot of the analysts kind of assume that the only live meetings are the ones that have press conferences. And given that only every other meeting has press conferences, if maybe they do intimate that they might change something, it could intimate that the next meeting is live or every meeting is live. At the moment, really, I think the market takes it only that press conference meetings are live, but this doesn't necessarily have to be the case. So changes to press conferences might be taken as a little bit of a hawkish surprise. And finally, the global outlook. I haven't elaborated here, but I think deserves a whole slide or quite some talk, just because last time round, in the statement, they were closely monitoring global economic and financial developments and is assessing their implications for the labour market and inflation and for the balance of risk to the outlook. They were very clear last time that the global outlook was influencing their decisions, and they were worried, a little bit worried about it. Now, global outlook could be touched upon in the statement again, the press conference, or the Q&A. Just want to bring up a STIRS chart again, because let me move this back to a daily chart. That's probably a bit bigger than I want. Okay, so if we go back to the last meeting, which was at the end of January, we've actually seen the STIRS rally on the meeting, but actually the STIRS actually rallied since after the meeting a good 25 to 30 basis points. And there was a time in mid-February that the market was pricing nothing for this year. Absolutely nothing. Actually pricing small rate cuts in the year. And that was, for me, a great opportunity to get short. I know one of our more senior traders here, Brannigan Barrett, put a fantastic trade on, a great risk-reward trade on selling the DEX 16 euro dollars, essentially very close to these highs. Didn't go offside, just because the market had overshot. The market was pricing nothing on the back of global concerns, and since then we've only gone one way, from the highs a good 35 basis points. Granted, he didn't take the whole of the move, but he took enough of it to be happy. And so where we are at the moment in terms of where the STIRS are is a little bit higher than in yield than we were, lower in price, higher in yield than we were come the January meeting. But what we've got to understand is where we've come from. We actually rallied a hell of a long way post the January meeting. The rate hikes were completely priced out. If the Fed meeting was this time last month, I would have been saying to you, there's nothing priced for the whole year ahead. The next hike is priced in the middle of 2017. But now I'm telling you the full price hike is priced for October of this year. So we've been and gone a long way over the last 6 weeks since the Fed meeting. And why I brought that up was essentially the pricing was a function of these global and financial developments, and the STIRS have sort of reflected that the situation is now a lot better than it was a month ago. 6 weeks ago, and so on and so forth. So China, for example, we generally saw depreciation of the yuan as as worrying, as an indication of a growth slowdown in China, China being the engine for global growth, and all that stuff. What have we seen since the last meeting in terms of China? Well, a slight appreciation, very slight, not much, but essentially stable. This here was, August, December, January. This was what the Fed were concerned about, this bit here. Their meeting was at the end of January, this depreciation here. Since then, okay, we've gone a little bit lower, bounced, and now it's a bit more stable. So the situation in China, I'm not saying it's better, but it's stable, and the market isn't as jittery about China. So that's one positive. So the outlook there seems to have improved a little bit. Emerging markets are more stable on the back of China generally. Let's have a look at the... Actually, let's not have a look at the dollar, but just simply for the fact that we're not that far from previous FOMC levels. In the past, they've indicated the dollar as a little bit of a concern, and the dollar strength ultimately has implications for growth and inflation, because essentially a strong dollar with weak global demand imports disinflation. To be honest, the dollar hasn't moved all that much from previous FOMC, so it's not something we need to, probably the Fed will bang on about too much, because not much has changed. Another positive, again, monitoring global economic and financial developments, is the US equities. They're back to year highs. Now if I bring up the S&P 500 chart, you can see here where we are now essentially was higher than, or around where we were at the very start of the year. This is what this down move here, first half of January, was very much what the Fed was concerned about. We're going from essentially 2070 down to 1800. Time of the last Fed meeting, we were about closer to 1900. Had a bit of choppiness, came down, but actually we've recovered, and in the last month or so, equities have been pretty buoyant and actually at the highs of the year. So again, when we look back to global developments, financial developments, ultimately we're in a better position than we were. Market knows that, so the Fed should be a bit more upbeat on these things. If they're not, that's extremely dovish. If they are, it's not necessarily hawkish because the market's expecting it, but it's hawkish in the context of if it's likely to get them back on the rate hiking path soon. Another thing, oil and commodities. Oil is still weak, although we're off the lows. And the Fed have said low oil could feed into low inflation in the short term, but they've actually consistently said that they feel this is transitory. Now, again, if we look at a chart of oil, okay, we're still pretty low, but we have bounced off the low levels. At a point, again, mid-January, we were like $27 a barrel, $26 a barrel in crude. Now we're at $36. Still, if we look over a longer period of time, oil is well below the lows. But maybe we've seen a low. We've got like a double bottom here, and we have bounced a little bit. So maybe the transitory nature that the Fed was talking about is proving to be correct, and maybe this is the start of an uptrend. I don't want to predict the oil market. I'm not going to predict the oil market, but ultimately, oil has bounced, and that probably should have some sort of influence, given that the Fed have said it's transitory. It's not a confirmation of it being transitory yet, but again, this should be more positive news for the Fed. And finally, it's not that relevant, but the US economy is the exception as opposed to the norm. There is monetary easing all over the world, and this probably does concern the Fed that others are needing to ease. I mean, the RBNZ have eased in the last week or so. The ECB cut rates and embarked on further QE. Now, that's a double-edged sword, to be honest. It could imply that, well, the global economy is not doing well, and that's why it's actually faltering even more, and that's why central banks need to act. But it actually could be seen as a positive to the Fed in terms of other countries are really trying hard and to get themselves out of this economic rut that they've been in, so to speak. Obviously, easing elsewhere probably makes the dollar stronger in relative terms, relative to those countries that are easing. But if that's the price to pay for a stronger global economy, I think the Fed will be more than happy with that. Okay, I will wrap up there. As I said at the start, today's preparation was basically the absolute minimum that all of us as traders should be doing in preparation for the Fed. We can make a lot of money out of these events. We do make a lot of money out of these events, but they're not easy. And if you're lazy and you don't prepare, you have no chance. Some of this you might think is too economist-like. Maybe it is, but again, that's the nature of trading central bank risk events. Knowing what's happened in the past, knowing the tone, the statement science, as I call it. Because if you don't know what's expected and what the central banker's stance generally is, you have not got a chance. You can trade price action. Some traders will trade price action. But to me, you're at a huge advantage if you understand the context as well. So there are many ways to skin a cat. Different styles can make money over these events, but there are plenty of opportunities. Remember, there's the rate announcement, there's a statement, there's a dots, there's a SEP, there's a press conference, there's a Q&A. There's so many opportunities here to make money. So the more you prepare, the more advantage you can, the more you can take advantage of these opportunities. And as I said, being prepared is the bare minimum. If you've got risk limits, if you're going to trade it, ultimately don't be gambling. It's no point gambling because you'll lose. You will just lose. Okay, so that's the preparation from me for today for the Fed. Obviously the meeting's tomorrow. Richard Bailey will give a few of his trade thoughts pre-Fed in tomorrow's end of day debrief, so it'll be interesting to see to hear his thoughts on some of his trade ideas heading into the Fed. But for me, all I've got to say is please prepare, please be ready. We can make money out of the FOMC meetings, and it could create some great opportunities. Anyone got any questions? They can either internally get hold of me on Skype or get in touch with me externally via Twitter. IMI_Futex Live is my Twitter handle. And I will sign out for today, and hopefully you trade well tomorrow. Thanks very much. Have a good evening.